and welcome to Economy and Markets TV, the show that takes you around the world of economic and financial news. I'm your host, Dave Okenquist, Senior Research Analyst here at Dent. Joining me each and every Friday, as you can see on your screen, is Mr. Rodney Johnson. Rodney is the Senior Editor and Co-Founder of Dent Research. Rodney, welcome.
Thank you, Dave.
As you can see, I'm back here in the official Economy and Market TV studios, back from Baltimore. It's good to be here, of course. And I can see you this time, which is nice.
Yep.
Now, in case anybody knows, Rodney and I recap the news of the week. We pick 3 or 4 big topics, try to go over them, keep things short. We've got about 2 minutes for us to go through them, and if Rodney goes over, I will ding him. That is the sign it's time to move on. So with that, let's get on to the big news of today, which is the U.S. job report. U.S. added 157,000 jobs in July. The unemployment number is down to 3.9%, which is just been hovering right around there, 4%. Now, the last 2 months, Rodney, we've been seeing job numbers of 250,000, right? So this is a little bit less than that. Do you make much of this report today, that being a bit down?
Well, in an economy of 160 million workers, it's really not that big of a change. But the big news of the jobs report is that it wasn't a big report. Being 157,000 versus 250 actually made people feel better. There was a revision to May and June, bringing an additional 59,000 jobs. And so it's not like it's a slowdown per se. But the fact that we're not plowing ahead, opening more positions, made investors feel a little bit better that perhaps we're not going to see wage inflation as businesses fight for new workers. Okay. Now, I think they're wrong. I think we are going to see that wage inflation, although that didn't show up in this report. Average hourly earnings were up maybe 2.7% for the year, which they were last month as well. But I think we're on the cusp of that because we have a lot of jobs openings out there, a lot of business saying, gee, I just can't find enough workers. Well, they're going to have to pay up to get the workers they want, which of course bleeds into the Federal Reserve. The Fed last Wednesday said they weren't going to change rates, which nobody expected, of course, in this off meeting. Right. But it is a worry that they're going to raise rates faster than anticipated in the months ahead as we see some inflation creep back into the system. So this jobs report gave people a little bit of comfort that perhaps that's not happening yet, but I still think it's out there.
And just a couple of little detail here. Yeah, you mentioned that 2.7% year over year for average hourly earnings. Now, CPI year over year is 2.8, so we're still a bit, running below inflation. But as you said, eventually, the business are just going to have to raise wages here, right? Which is going to lead. Well, the problem is, will that in turn keep pushing prices up?
Well, and you get prices going up on both sides because if consumers have more money because they're earning a bit more, it can come out of business profits, of course, and so they could be spending more. But you also have businesses saying, look, I'm operating at a fairly efficient level, and so in order to pay those higher wages, I'm going to charge higher prices. And so it could be that, the wage gains get eaten up through inflation, but they do still go higher, which of course brings in the Fed.
Quick thing before we move on, do you expect a rate hike next time?
I do, absolutely. In September is the next meeting of the Federal Reserve. They're going to raise rates. They have done everything but taken out a skywriter to tell you they're going to raise rates.
Okay, great. Thank you there, Rodney. All right, let's hit our next topic. This is the U.S. Home Price Index. In fact, the S&P Case-Shiller CoreLogic. Everybody wants their name on this thing, right? That's why.
We should go buy that, and then it would be the Dent Research, S&P, CoreLogic, Case-Shiller, blah. I don't even know what it is anymore. It's just the home price index.
Yeah, exactly. Well, anyway, that one is up 6.5% year over year. Rodney, I feel like a broken record talking about this. We got home prices rising, rates are rising. Something isn't giving yet. I don't know what it's going to take. What do you think?
Right. And it is a bit of a broken record, which is interesting for real estate because it is a very slow-moving market, right? It is the aircraft carrier. And so we've talked about real estate now for years with prices going higher, but you see wages going sideways, as we talked about just a minute ago. Right. But now we're seeing home sales, as we talked about last week with existing home sales and new home sales, actually going sideways and even down a little bit in existing home sales. And so as they're going down, but prices are remaining high, something's got to give to bring these two back. And so do prices come down or do sales turn around and move back up? I think that you're going to see a little bit of both. I think you're going to see prices come in a touch, but I also think you're going to see people spending a bit more if they do get that wage inflation that we talked about a minute ago.
Yeah. All right. Because that's something we're certainly going to keep an eye on. So let's change that record at this point. Let's move on to something else.
Yeah.
Looking across the Atlantic Ocean to Europe, got some news out of them. Now, last week we had U.S. GDP come in on Friday at 4.1%. However, in Europe, it's just 2.1%, which is actually at nearly 0.5% lower than it was in the previous quarter. Consumer prices they're 2.1%, as I mentioned earlier. That's year over year, 2.8% for the U.S. So they're lagging on growth. Their prices are really stubborn over there. So what does that mean for Europe as a whole, and what the ECB is going to do, Rodney?
And that is the question, right? Because you have these central banks pursuing different policies, whereas in the United States, of course, our central bank is taking money out of the system, and they are pursuing higher interest rates. You have to remember the European Central Bank is still buying 30 billion euro of bonds every month. So, $32 billion worth of bonds every single month. And they also are holding their deposit rate at a negative 40 basis points, which is just crazy, right? It's been years in the negatives. And so they've pledged to stop the bond buying by the end of this year. And they've talked about raising interest rates starting next summer, perhaps. And so this puts them in a bind. If their economy is slow, if inflation's not there, how in the world can they pursue tighter monetary policy? But if they don't, and the United States keeps moving away from them, then what happens is it pulls capital. And so we're going to become the attractive base for capital for the world, which basically we are. I mean, at 3% on the 10-year Treasury, we are the high yield offering of the planet of developed economies. And so that's one thing keeping rates down here. We would expect higher rates with everything going on, economic growth, and of course, Fed tightening. But everybody's buying treasuries because they're looking around going, where else can you get 3% for 10 years on that type of quality? And the answer is nowhere.
Yeah. We did get, I think it was last week, with the president met with the leader of the EU, and they talked about some trade policy, maybe opening things up and ending this spat. Do you think that can help growth for Europe?
I don't think so, because the trade wars as they are, the trade spat or whatever, is so new that it's just starting to affect what's going on both here and abroad. And so it's not as if European countries have been dealing with this for 7 or 8 months and it's showing up in their statistics, which are all backward looking.
Right.
And so their GDP and inflation numbers, it's all about the last 6 months. It has nothing to do with basically July 1 forward. So these trade tariffs or trade spats are just going to make things a bit worse.
Thank you, Rodney. Our next item we have is U.S. motor vehicle sales down 700,000 on an annualized basis. They fell from 7.5 million to 6.8 million, which is less than expected. How big of a deal is this, Rodney, and what does it mean kind of going forward for auto sales? You think this is volatile? Is it part of a larger trend?
I think it's part of a larger trend. You saw auto dealers reaching down. They were selling to lower and lower credit quality buyers. And so eventually you're exhausting that bucket. And we have a lot of new cars out there. We supercharged new car sales after 2010, if you remember the cash for clunkers, which people don't talk about. But I mean, my goodness, this was a huge undertaking. And so we've allowed the auto dealers kind of retool their fleet. There are more SUVs and pickup trucks, which are higher profit. Ford is basically ditching every sedan or car except for, one of these little Focus things in the Mustang.
Yeah.
And so they've really been moving toward what customers like, but eventually customers got cars. And so I think it's part of a larger trend. I think a little bit higher interest rates also take some buyers out of the market. It is interesting to note that General Motors doesn't report monthly anymore, just quarterly.
Right.
And so that number is a little bit of a massaged estimate of what's going on without GM in the picture. I think they would have been the same anyway.
Yeah, and we also, there was an article on Yahoo Finance about consumer taste. People love the crossovers. They don't like the sedans very much anymore. You get that little bit, you sit a little higher, maybe a little all-wheel drive. So I guess American companies are going to have to maybe adjust to that as well.
And I think they are. And I think a big part of that is actually the aging of America. Certainly, sitting up high is great. Getting in and out of a car can be difficult as your mobility changes. And so if you look at those crossovers, not the full pickup trucks or SUVs that you have to step up into, but those crossovers where it's really a lateral move of the hips to get onto and off of the driver's seat, it's much easier for people. And so it just makes perfect sense that would kind of be the next evolution of our cars.
Excellent. We have a little bit of time. So speaking of cars, Something funny here. Well, we like to pick on Tesla, right? But
I do, that's for sure.
Tesla sold some surfboards to some great success, Rodney. So, if they can't sell cars, at least they can sell Tesla-branded surfboards.
So he sold 200 surfboards last weekend. They sold out in 2 days, charging $1,500 a piece. I can't imagine they cost $1,500. Say they cost $500. He still made $200,000 in profit on surfboards, which is really good because he burned $700 million trying to make cars last quarter. Tesla, of course, announced earnings, which were worse than expected. Instead of losing only like $2.96, I want to say they lost $3.03 a share or whatever. But the news in there was the rate of making cars, where they say that they hit the weekly rate of producing the Model 3 at 5,000 units a week. They hit it several times. Now, I guess that's good, right? And they say that they're going to be making 6,000 per week by the end of August. But more importantly, Elon Musk says it is green from here on out, meaning profits. He sees nothing but blue skies from here to eternity.
I've never heard that before.
And so people took that from the guy who's burning $700 million a quarter and said, well, clearly everything's great. So let's run up the shares. It's just crazy.
Well, I don't know. Maybe he's just in the wrong business, Just.
Well, and it's interesting you say that. Now, I give him a lot of credit for things he's done in the past with PayPal and other things. Clearly a brilliant guy, but an uncle of mine, we trade emails on a lot of things going on, and he said that Elon Musk is the P.T. Barnum of his day. And I couldn't agree more in some aspects of this, because he just keeps selling this story to people, and clearly enough people buy it. The stock jumped 10% on the next day after earnings.
Yeah, absolutely. Great stuff on there. I guess it's he's now become a feature of the show. Yep. Looking ahead to next week, we've got U.S. CPI, consumer prices. Anything else on your mind, Rodney?
Not really. I mean, we're getting into August. It's the dog days of summer. Anybody who's anybody is off at the coast, which tells you who we are, because we're not off at the coast.
Right.
But it's all going to be about trade, I'd imagine. We're going to have a lot of information flying around about what's going on with the different relationships. NAFTA is something to keep on your radar. The new president and legislature in Mexico, they've been conciliatory. They're saying, hey, look, let's do this. Let's kind of get this new thing going and kind of move out the door.
Right.
And so we could see some movement on NAFTA. And Venezuela looks like it is finally, truly falling apart. And so there could be some big eruptions out of that nation in South America. So those are the things to watch.
Absolutely, Rodney. Thank you, everybody, for watching this week, and we'll catch you next week.